Mike Muller, head of Vitol Asia. Mike, the Brent crude traded closed last week 84.89, under $85 a barrel. Again, the same question to you. The markets seem to have come to the point of view that this is a non-event really for the oil markets and for traders and pricing of oil. What does it mean then that the downward sort of flow is the sort of neutral position is downward, not the neutral position is upward, that the market wants to decline once it removes the geopolitical risk?
Yes, I think describing what's going on in and around Gaza as a non-event, of course, is probably taking things a little too far. There
absolutely. I mean, I have to. I mean, you're absolutely right. It is a major event. It is a major event, and of course, a major tragic event of human life loss. No doubt. I take your point 100%.
No. I mean, official data pushing 10,000. This is very serious. But I think there is still some, but maybe not as much risk premium associated, because of course there was the potential for the situation to escalate out of hand, with potentially more than one front of activity with the Israelis would be confronted with. And I think it's fair to say, I guess, that some of that risk premium has gone out of the market, just because we've now had 4 weeks and a few days elapsed since the initial Hamas action on the 7th of October. And as a result, the market has concluded that risk premium can shrink. There is, of course, also a risk premium in the gas markets. We mustn't forget that there's a lot of gas produced offshore in the Levant area between Israel and Egypt and Cyprus. And there have been some losses there as well, of course. But I think the backdrop is still one of concern over global economic welfare. There was a headline, I think, in your digest, one of your 10 headlines, about a massive container company laying off some staff.
AP Muller Maersk laying off 10% of its staff because container shipping down.
And I mean, it's reporting season, and whilst the energy giants have reported reasonably creditable results, the concern remains about global trade. And I think it's not just the container sector, but general concerns about how much money the Chinese central government is throwing by way of stimulus at the economy in order to maintain the metrics they wish to see. There are some out there that do feel that the GDP growth rates in China will take a lot of helping in order to maintain themselves. That, of course, then reverberates around the planet. So then the question is, what's happening at the very front end of the market? And I think in one of your midweek podcasts, one or two of your commentators observed that there's a fair bit of spot oil around in certain pockets, which are liquid price discovery points in the Atlantic Basin. And you then have to marry up, why do we have healthy refining margins? Why do we have $85 Brent? And yet we have a lot of surplus oil at the front of the market, and yet we still have a strong backwardation in the market. So I think traders are less concerned than they were perhaps a month ago about requiring a bit of oil at the front of the market. And likewise, governments who look at strategic petroleum reserves might have stepped in and acquired some of those reserves, and there's been very little evidence of that going on as well. I think it is fair to say that there was some extra interest in the initial days to secure oil outside of Hormuz as opposed to inside of Hormuz. But again, that risk premium is also dissipated.
Mike, just picking up on that China outlook, all things being equal, China demand remains fairly solid, maybe not growing as was forecast at the beginning of the year at very big numbers, but nonetheless, it's still at a solid import level. What's your outlook now as China kind of moves into the winter peak demand window and the sort of China New Year coming up in January?
Yeah, perfect question. I think we have to remind ourselves, this is the time of year when demand in Asia peaks, but demand in the Western Hemisphere tends to ebb to a low because of less driving activity, winter conditions, etc. But what we see going on in China is quite interesting, because the fuel sale data on a weekly basis does not really show evident signs of economic weakness. Diesel sales are in line with expectations. Jet demand is indeed robust, exceeding expectations. Singapore Airlines just laid on 5 extra flights a week from Singapore to China. They don't tend to do that unless they're confident there'll be passengers on those seats. And it's only really gasoline that's shown a steeper than expected dip in October, but there's a reason for that. There was a public holiday Golden Week. But the one thing that has happened in China that's quite notable is that refining margins have dropped to the lowest levels we've seen in a very long time, and certainly the lowest level this year, in some cases bordering on the negative. So why are Chinese margins negative? I think the explanation is that runs in the third quarter, which were 1 million barrels a day more perhaps than the same time last year when we still had COVID, so always difficult to compare, but they were likely a response to high demand expectations that were possibly unreasonably high. And at the same time, I guess there was a bit of destocking going on. And as a consequence, now we've seen all this translate into higher than expected stocks. And if the stocks are unseasonably high, the only consequence is that you push domestic prices down, you push refining margins down, and you force run cuts. So it goes without saying that China will either need to continue running its refineries and building stock at low margins, or that there'll be a drop in runs, and that'll manifest itself into lower appetite for crude. And that's highly visible since China is such a significant global importer of crude oil. And I think those are the signs of softness that the market's been detecting.
Looking at it from the perspective of the oil markets and the geopolitical risk, do the events of the last few days, the sort of meetings with this sort of splinter between the Arab countries and America, the position, the big speech by the Hezbollah leader last week, does this indicate that the possibility of a return of geopolitical risk into the oil price, or is it still a neutral posture, do you think, going forward?
Very many questions here. I think without a doubt, the speech from the gentleman in Ramallah was reassuring in many ways, because it wasn't quite as bellicose as maybe some had feared. But we have to remind ourselves, and Christoph's already touched on this, the region was heading towards some very exciting developments. Many leaders in the region have opened their dream, their ambition of turning the Middle East into a leadership position. The Emirates are hosting COP28 later this month. And there was a peace process going on, which was resulting in a rapprochement, not just between Israel, the Emirates and Saudi Arabia, but between those countries and Iran. And many at the time said that
that point on that between Saudi and Iran obviously was shepherded by China. Does China have a position on all this? I mean, very quiet, or do they have influence?
No, I'm sure behind the scenes. I mean, I've not seen, and maybe I've just missed the evidence, but I'm sure there's plenty of diplomacy going on or in the works there. But back to your question on the US, I mean, there are a few things that are happening concurrently with this backdrop of a strong desire for this event that has the potential to scar a nation for an entire generation, not just a nation, a region for an entire generation, to be contained as quickly as possible, because the deeper it goes, the more difficult it will be to realize dreams like the economic success around developing infrastructure such as NEOM, for example. I think a bunch of things this week on the part of the US have also sort of drowned in the background, but they're quite important to look at as well. I mean, for example, there has been an extra round of sanctions imposed on Russia to further tighten the conduit of goods via those channels that the G7 wished to see clamped down upon, and a few high-profile upstream producing entities have been added to the list of entities that are sanctioned. At the same time, General License 44, which essentially opens the taps for Venezuelan exports, is a very significant step to cool oil markets, which is clearly a priority for the Biden administration also. And how that oil works its way into the market is yet to be seen, because there are three issues, of course: the infrastructure, the actual ability to produce, and the channels whereby the monies flow. And we must remind ourselves, a lot of countries and companies are owed billions by Venezuela. But the logic would dictate that those streams from Venezuela would flow to the US and thereby release other grades of crude for Asia, rather than those grades traveling all the way to Asia as they have done now. And then, of course, there's the very delicate tightrope that Blinken's been treading, which we've been watching all weekend, which I don't think anyone's going to be happy with the outcome, because there is a big swing of consensus, of course, across the Arab world, where you're sitting, Sean, to see some sort of diplomatic solution found to stop any further escalation and bloodshed.
Mike, your thoughts on the OPEC plus outlook decision this month, and of course the Saudi voluntary cut of 1 million in conjunction, Mike, with the idea of what it means to Asian, if we have reached plateau rates, then the dollar weakness, the dollar strength we've seen comes off, and maybe that's a bit of a relief for Asian importers, and also gives OPEC Plus and Saudi a bit more space. Your thoughts on all of those issues going forward?
I'm not sure that much has changed, other than what I said about China, where there's been a bit more domestic stock building than perhaps the market expected, but against a backdrop of decent demand. I mentioned diesel, but I mean power demand in China has been pretty robust also. So that combined with a bit of uptick in aviation means there's scope for some upward revisions in certain segments of China. But I don't think there's a significant encouragement in the form of extra demand or supply going missing anywhere that would cause Riyadh to change tack.
What about the carrying? At the end of the day, this is, Mike, a big extra burden for Saudi. We're seeing their budget deficit now being published, and a decline in revenue. I mean, 1 million barrels a day off the market is a very big bucket for them to carry for everybody else. Does that sustain? Is there any sense that others, they may not be willing to carry that bucket for much longer as Guyana grows its capacity, as Venezuela comes back, and so forth?
I think all that is in their balances already. I don't think there are any surprises. So if anything, history shows us that the bringing on stream of new projects, be they refineries or be they oil fields, tend to be beset with delays. So I mean, whether or not every single one of the offshore projects in the Atlantic Basin will be on time as scheduled next year remains to be seen.
And vis-a-vis any demand destruction at these price levels, Mike, going into Asia winter peak, any signs there, or the Asian economies can handle this $85-90 oil through the coming quarter?
I think the significant economies are pretty robust and able to handle price in the 80s. Not least as articulated by His Excellency Minister Hardeep Singh Puri of India, who stated at ADIPEC that 80s is just fine for India, they can afford it. I believe that's what he said.